made. The first column, you'll see that I've given some weightage to investment criteria like strategic fit, payback period, export potential, technical difficulty, and access to local raw materials. So this is specific to an organization where these things were important. So I've given a weightage of um, 20% to strategic fit, 5% to payback, 15% to export potential, technical difficulty 10%, and access to raw materials another 10%. So that is 20 and 40 and 60. Well, I think I need to reallocate. It should total to 100. So the weightage has to be 100. But then there is a scoring system. So the scoring system that I have put in is 1, 2, 3. So the most attractive is 3. For example, strategic fit for a life science project is 3. For nutraceuticals is also 3 in this case. And guess what? Some of the companies are doing cosmetic business, which kind of supplements, and I've also scored them as 3. Payback period um, is less than 3 years is very attractive. So 3 years, 3 to 5 years, I've given a score of 2.2, and plus 5 years, I've given a score of 1. Similarly, export potential and technical difficulty, so they have a different scoring, 3, 2, 1. And access for high access for raw material, the score is 3. So this is one way of uh, doing a weighted analysis of different projects. Next slide, please. So this slide actually shows that I have got about 11 projects, um, and they have different investments. So there is an initial cost of $15 million, $20 million, $25 million. So there are 11 projects. Um, then so you do financial analysis, you put NPV, you do IRR, you do payback, and then you do a financial attractiveness. But then you also, as discussed in the previous slide, you also do the weighted analysis. So the 60% is the strategic fit, and the 40% balance is the financial attractiveness. So here you will see that for each project, I've deleted the specific details of the projects because that's confidential. So this was a pharma company where they had a choice of entry into biologics, entry into vaccine, so various new products, new disease areas, etc. So we estimated the value of investment. Then we looked at the strategic fit scoring, then looked at the competition and markets and our financial attractiveness. And there are different scores here. Look at the export potential, look at the technical difficulty and access to raw materials. And then I sum all the scores, and based on these scoring, the project B is ranked number 1. It has got the highest score at 2.575. Project A is the next 2.45. So this is an example where you are able to list down all the opportunities, and you actually do a ranking for these. And you can actually uh, updating this template with new projects that are coming in next next year, and when you're doing the next review. Next slide, please. Next slide, please. Right. So why is it so important, the strategic allocation? We have discussed this a bit, but the first of all, why is it critical is the value creation, because it directs capital to high return opportunities. Number 2 is strategic alignment. It ensures investments support the company long-term vision. Risk management, it balances growth investments and risk mitigation. And competitive advantage, the funds initiatives that strengthen its company's market position. And finally, resource optimization, it prevents wasteful spending on non-strategic or low return projects. Next slide. So, so there are various methods of ranking and prioritizing projects. So we've seen some example, the strategic alignment scorecards, the financial metrics will be, as you would know, that net present value, internal rate of return, payback period, return on investment. These are various KPIs. And then the qualitative factors like risk profile, resource availability, feasibility, and flexibility, optionability. So these are various factors which you can put in your um, weighting. You can select them if they are relevant, and then the example that you saw. Next slide, please. So there is mostly there are two aspects after doing your market opportunity. There are two feasibilities that needs to be done. One is technical feasibility. So the question is, can this project realistically be implemented and function as intended? So you need to assess the technology, its maturity, its reliability, its integration with existing systems. The engineering part, whether it's sound design, the site is suitable, infrastructure requirements, operational impact is the scalability of the project, its maintenance needs, and what are the skills required, and resource availability, what is the internal expertise, vendor capability, supply chain consideration, etc., and the timeline, whether project schedule is realistic or not. And the goal is to ensure that the proposed solution is viable, buildable, and operable. And it involves to it's good. We should be involving our technical experts early on when we are doing this technical feasibility. Next slide, please. So next comes the financial evaluation. We've seen some evaluation earlier in the example. So the question is, does this project makes financial sense and meet our return hurdle? I'll explain the return hurdle in my next slides. So, sorry, can you go back again? So the key financial metrics is how much is the total investment cost? What are the operating cost savings? What is the revenue impact? What is the payback? What is the net present value? What is the IRR, internal rate of return? And what is the profitability index? So profitability index is the ratio of present value of future cash flows to the initial investment. So this is also used for ranking. And also do sensitivity and scenario analysis. This will actually show the assessing impact of changing assumptions, for example, cost changes or revenue changes or timing changes. So you actually do a scenario analysis or sensitivity analysis to get a better feel of any change in the assumptions. Next slide. So some of the tools and frameworks for alignment include the balanced scorecard, the strategic buckets. Strategic buckets is something that you actually allocate capital into a predefined pools of based on strategic themes. For example, 20% of budget will go to maintenance, 15% to compliance, 35% to efficiency, and 30% to growth. So you actually decide on prioritize and then allocate your budget based on the strategic buckets. Then you have another method called stage gate or phase gate process, and this is a strategic review of for major projects, revalidating strategic fit and feasibility as milestones before committing further funds. So normally for example, in pharma and in pharmaceutical companies, they have a lot of ideas and they call it innovation funnel. And there are various stages that the projects go through. And investment is in the last stage. So they do, uh, they collect all the projects, they do the feasibility, they do technical feasibility, financial feasibility, and then go to the approval. Then we have the capital expenditure request form. And these are standardized template ensuring that all proposals address all the strategic rationale, technical aspects, and financial justification, risks, and alternatives. It's a best practice so as to standardize capex decision making, investment decision making. and to have a uniform standard for all the investments. So this typically contains all the financial parameters as well as strategic uh, themes that the project is there. The next is a portfolio management approach, and this is looking at the investments, all the capex projects as a portfolio to be balanced according to the strategic risk and return. So, portfolio could be that, say, for example, in Unilever, 50% of the business was foods, but it was not a priority, so you will not be spending 50% of your capital budget there. So, for example, their uh, priority is now um, personal care. A disproportionate amount. So, if supposing the business contribution of personal care is only 30%, they might be investing 50% of the capital budget because this is strategic priority for them. Next slide, please. Some more examples. In scenario one, there is a growth strategy. That we need to enter the South Asian market within next 3 years. And the aligned capex could include investment in a regional manufacturing facility in a strategic location after a thorough market, technical, and financial feasibility. So this is an aligned capex to the growth strategy. What could be a misaligned capex is spending heavily on upgrading domestic R&D labs unrelated to international expansion needs. So this is an example whereby the limited budget could be misaligned by spending on a domestic R&D as opposed to investment in Southeast Asia. The second example is of an efficiency strategy. So the strategy is to reduce unit production cost by 15% in 2 years. Again, Mihai would be quite upset that this is not a strategy. This is the role of the operations department to reduce the cost anyways. So, excuse me, Mihai. The aligned capex would be to invest in robotic automation for a key bottleneck in the production line, demonstrating a clear ROI in technical viability. So, so you have a production bottleneck or the production unit cost is high, and by introducing a robotic automation, you are able to reduce production cost and remove any production bottlenecks. So this is a good example. In case of it's funny, but it happens. Misaligned capex would be purchasing a new fleet of executive cars. So all the BMWs and the Mercedes uh, are being replaced, and sometimes it's crazy. And sometimes my board has also challenged me that your car fleet replacement is more than your business investments. So we had to prioritize it based on our strategic allocation. So next slide, please. So overall, the capital allocation requires a disciplined execution so that it brings strategy to life to have a successful execution. So an approval of the capex is not the end. Effective execution is crucial for realizing strategic benefits. So the key success factors would include strong project management, defining clear scope, budget adherence, time management, and this can have Gantt charts and milestones. Then you need to have a cross-functional teams that who collaborate between finance, operation, engineering, IT, etc. Thirdly, vendor management, a rigorous selection, contract negotiation, and performance monitoring of vendors. Change management, so we must communicate the impact of change. We need to train the users, and we need to address any resistance to change. Then you need regular reporting and oversight, tracking progress against the plan, early identification of any issues. So, by following a disciplined approach, your projects would be of success. Next slide, please. So this slide actually tells you about the sources of financing capital budget. or capex or future investments. So some of the internal resources include retained earnings. So you made profits, but you have not distributed as dividends, and this is the most cost-effective source as it avoids any external financing cost. So, say for example, made a net profit of 100 million. So instead of distributing 100 million, you make a dividend of 50 million and you retain $50 million. So this is that $50 million, and you keep on accumulating it over the years, and this fund is available for making capital investments. Secondly, depreciation and amortization that gets charged into your P&L. So these are non-cash expenses, and they generate internal cash flow. So if you look at the cash flow statement, you'll say net profit, and then you add non-cash expenses, and that includes um, depreciation and amortization. So this releases another set of cash available for investment. And lastly, as mentioned, the divestments, sale of assets, and divestments of non-core or underperforming assets can also generate internal cash. So the Unilever sale of tea business or margarine business, or the Novartis sale of OTC business generated cash for the group, which they can deploy in their next projects. What are the external sources? Number one is debt financing. That includes bank loans, which is like fixed term loans, or there are lines of credit. Then, secondly, bonds. So, issuing debt securities to public or private investors. These can be a fixed period. The advantage is that the interest is tax deductible and there is no dilution of ownership. So, in the okay so disadvantage is that regardless of company's performance you have to make fixed payment obligation, and this increases the financial risk. Another source, it's external, it says equity financing, and this could be by issuing new shares and selling ownership stakes to investors through public offerings or even private placement. The advantage is that there is no fixed payment obligation and it strengthens the balance sheet. The disadvantage is that it dilutes the existing ownership. It is the cost is higher, um, as equity cost of equity is higher than the debt finance. So that is because there is more risk in it. It's therefore the cost is higher. The choice of financing mix significantly impacts the weighted average cost of capital, which is the average rate of return, and the company expects to pay its investor, minimizing the WACC while maintaining a healthy capital structure is the key. So this weighted average capital is the average of cost of equity and cost of debt, and this is used as the discount rate for calculating the NPV uh, investments. Next slide, please. Next slide is all about, so after you've done the ranking and you've looked at your capital budget, so you present to the board um, the capital budget proposal. So for all the significant strategic investment, board approval is required. The board of directors provide an oversight, ensure alignment with the shareholders' interest, and holds management accountable. Their roles include reviewing the strategic rationale and the financial projections, assessing the risk involved, ensuring appropriate governance and control are in place, and approving the capital expenditure budget. So they look at from overall point of view, from corporate point of view, whether these investments are aligned with the corporate strategy, that this is a good strategic fit, and whether the investments are within their risk appetite. So this is the last stage of approval. Next slide, please. So post capex, what are the controls and monitoring to ensure that the we are getting our strategic uh, advantage? So the way to do it is to check whether the investments deliver the intended strategic and financial benefits. And how we can do it? That we can do a post-implementation review conducted 6 to 18 months after the project completion and compare the actual cost and benefits versus the original business case, assess if strategic objectives are met, and capture any lessons learned for future projects. For ongoing KPI, and secondly, ongoing KPI tracking. So we must continue monitoring metrics linked to the project's justification, for example, production output, cost per unit, system uptime, market share, etc. And lastly, uh, holding project sponsors accountable for delivering the promised results. So this is post-implementation review to ensure that the projects that have been invested, they are delivering as per plan. Next slide, please. So this slide is all about the key risks and the mitigation strategies. The first one, very importantly, is the strategic fit. So changing market strategy, market conditions, and so there is a strategy shift. So the mitigation strategy would be doing a regular strategic review, flexible project design, scenario planning, and clear go no go criteria. Now, this is part of the strategic review. Previously, in the olden days, we used to do strategic review every 2 years. Then it became every 1 year. And now my boss tells me to do a strategic review on a quarterly basis. So, um, so we need to continually evaluate our investments going forward as well by doing strategic review. So financial risk, we have to see the kind of risk are cost overruns, benefits not realized, and there could be funding issues. So the mitigation strategy would be to do a robust estimation, contingency budget, sensitivity analysis, strong financial controls, and post-implementation review. Technical and operational risk. There could be technology failure, integration issues, and there could be delays. So the mitigation would be doing a thorough due diligence, pilot projects, skilled project teams, and expert consultation. Execution risk. There could be poor project management, scope, or a vendor yes, scope. Vendor failure and strong PMO. So the mitigation would be to have a strong project management office, clear scope, change control process, robust vendor selection. Lastly, external risk could include regulatory changes or the economic downturn. So the mitigating risk could be environmental scanning, and as I said, do quarterly, flexible planning, and contractual protection. So these are some of the key risks when doing capital budgets and how we can mitigate these risks. Next slide, please. So my last slide, actually. So what are the key takeaways from my presentation today? Is that strategic alignment is paramount. CapEx must be directly support and enable the achievement of business strategy. Next, it's a continuous cycle. You do strategy, you identify capability gaps, you allocate budget, you evaluate, you execute the project, you monitor, you feedback into strategy. Thirdly, this entire process requires discipline. We must have robust process, rigorous analysis, technical and financial, and strong governance are essential. Totally cross-functional effort. So every large project has a cross-functional impact. So the success depends upon the collaboration across the organization. And lastly, the finance role is to be a strategic partner, facilitator, guardian of financial prudence, and a validator of value creation. So these are the key takeaways from my today's presentation. Next slide, please. It's a thank you for your time and attention. I welcome your questions.
Okay. Very insightful lecture, Khalid Saab. So as usual, so it's amazing session. Let me see if uh, Yeah. Okay. So I think it's a great topic. It's very rarely people understand about the importance of capital allocations. Okay. So you have nicely explained.
Thank
Okay.
you.
So thank
Thank
you
you.
very much.
All
And
right.
due to time constraint, we will have to take it to the next speaker. So I sincerely thank you on behalf of all participants and also the organizers. Thank you, Khalid Saab.
Thank you. Thank you for the opportunity. Thank
Wonderful
you.
session. Wonderful session. Any
All right.
questions will be posted here,
Right.
and then you can answer them offline. So
Thank you
thank you,
so
sir.
much.
Thank you very much.
Bye bye.